Ever wondered how to make money in the stock market? Let's demystify it for you. At its core, the stock market is a marketplace, very much like your local grocery store. But instead of buying fruits and vegetables, you are buying and selling shares of companies. Now, what exactly does it mean to own a share? Imagine a pie. This pie represents a company. Each slice of this pie is a share. When you buy a slice, you are buying a piece of that company, making you a shareholder. As a shareholder, you own a portion of that company. And this ownership gives you the right to a portion of the company's earnings, its assets, and even voting rights at shareholder meetings. Companies issue shares to raise capital. This capital could be used for various purposes such as funding expansion plans, paying off debt, or even for research and development. In return, as a shareholder, you stand to gain from the company's success in the form of dividends or an increase in the share price. But who are the people buying these shares? Well, there are two main types of investors. First, we have retail investors, which could be anyone like you and me, buying shares for personal investment. Then, we have the big players, the institutional investors. These are entities like banks, mutual funds, and insurance companies who buy shares in large quantities. Now, how do we measure the value of a company in the stock market? This is where the term market capitalization comes in. It's a simple multiplication of the number of shares a company has issued by the current share price. This gives us an idea of the company's size and worth in the market. But remember, investing in stocks isn't just about buying low and selling high. It's about investing in a company's future, its vision, and its potential for growth. However, just like every investment, it comes with its own set of risks. So in essence, when you buy shares, you're buying a piece of a company, and your fortune is tied to the company's performance. So choose wisely, and happy investing. Ever heard about IPOs? Let's understand what they are. When a company decides it wants to expand, it often needs to raise capital. One way to do this is by going public through an initial public offering, or IPO. This is a pivotal moment for a company, as it transitions from private ownership to public trading. In an IPO, the company sells a portion of its shares to public investors for the first time. The money raised from this sale is then used by the company to fund its growth and expansion plans. It's like a grand introduction of the company to the stock market. As an investor, IPOs can be exciting. They offer the chance to buy shares of a company at the ground level, often at a relatively low price. If the company does well, the value of these shares can increase significantly over time. An IPO can be your ticket to owning a part of your favorite company. Let's talk about the different players in the stock market. There's a diverse cast of characters, but for now, we'll focus on two main types: retail investors and institutional investors. First up, retail investors. These are everyday people like you and me who buy and sell shares for personal investment. We might invest in a few companies we believe in or diversify across several sectors. Our purchases are often driven by individual research, financial goals, and sometimes just gut instinct. On the other side, we have institutional investors. These are the heavyweights: banks, mutual funds, insurance companies, pension funds, and the like. They buy and sell in large quantities, often influencing the market's direction. Their decisions are typically based on detailed research and complex investment strategies. So, whether you're a big bank with deep pockets or an individual looking to grow your savings, the stock market is a stage set for all. Anyone can participate, each in their own way, contributing to the market's fascinating dynamics. Whether you're a big bank or an individual, the stock market welcomes all. How do we measure a company's value in the stock market? Let's dive into market capitalization. Imagine the stock market as a bustling city, and each company as a building within it. The size of each building isn't determined by how many windows it has or how tall it is, but by its market capitalization. Market capitalization, or market cap for short, is the total value of all a company's shares of stock. It's a simple equation, really. You take the current stock price of a company and multiply it by the total number of its outstanding shares. This calculation gives you the company's market cap, a clear-cut, real-time indicator of a company's worth. Think of it as a quick snapshot, a way to compare the relative size of different companies. A larger market cap often signifies a larger, more established company, while a smaller market cap can indicate a newer or smaller firm. Market capitalization gives you a snapshot of a company's worth. Why should you invest in stocks? Let's explore. The stock market, despite its fluctuations and uncertainties, holds an undeniable allure. It promises a path to financial growth and prosperity, a way to build and secure your wealth. But why invest in stocks? Well, one primary reason is the potential for high returns. Stocks have consistently proven to be one of the most profitable investment avenues, historically outperforming other assets like bonds or real estate. When you buy a stock, you're essentially buying a slice of a company's future. If the company thrives, so does your investment. As the company grows and prospers, the value of your shares rises, leading to capital appreciation. Then there's the benefit of dividends. Some companies distribute a portion of their profits to shareholders in the form of dividends. This means, as a shareholder, you could be receiving a steady stream of income, even as your investment appreciates in value. There's also the power of compounding. When you reinvest your earnings from dividends or capital gains, you buy more shares, which could potentially earn more dividends and capital gains. Over time, this snowball effect can significantly boost your overall returns. And let's not forget the flexibility. The stock market offers a wide array of investment options, ranging from blue-chip companies to emerging startups, from sectors as diverse as technology to healthcare. This allows you to diversify your portfolio, spreading your investments across different industries and reducing the risk. But remember, with potential for high returns, comes the risk. Investing in stocks isn't a guaranteed pathway to riches. The market can be volatile, and stock prices can fluctuate dramatically. You could witness your investments plunge in value. That's why it's crucial to have a well-thought-out investment strategy, to do your research, and to be patient. Investing in stocks isn't about making a quick buck. It's about investing in a company's future, in your future. It's about being part of a company's growth story, and in the process, writing your own. With potential for high returns comes the risk. Always remember, invest wisely. Investing or trading, let's understand the difference. Picture this: investing is akin to planting a seed and patiently awaiting the growth of a mighty oak, while trading is more like planting fast-growing crops, regularly harvesting and replanting. Investing is a long-term approach, where you purchase stocks with the intent of holding them for years or even decades. It's about building wealth gradually and benefiting from the power of compounding. It's closely tied to the fundamentals of a company, its growth potential, and the overall health of the economy. On the other hand, trading is a short-term strategy. It involves buying and selling stocks more frequently, often within days, weeks, or a few months. The goal is to profit from short-term price fluctuations in the market. It's less about the company's fundamentals, and more about capitalizing on market trends and volatility. Whether you're an investor or trader depends on your financial goals. Before you dive in, let's talk about managing risks. Risk management, you see, is the cornerstone of successful investing. Without it, you're just a gambler hoping for the best, and hope, as they say, is not a strategy. So what exactly is risk management? In the context of the stock market, it refers to the process of identifying potential downfalls and taking appropriate steps to mitigate them. It's about not putting all your eggs in one basket and never betting more than you can afford to lose. Now let's break it down into digestible bits. First up, diversification. This is the practice of spreading your investments across various assets or asset classes to reduce exposure to any one particular investment. Think of it as not putting all your eggs in one basket. If one company or sector underperforms, your entire portfolio won't take a hit. Next, we have position sizing. This involves deciding how much of your portfolio to invest in a particular asset. A common rule of thumb is to never invest more than 2 to 5% of your portfolio in a single stock. This way, even if the stock plummets, your losses will be limited. Moving on, let's talk about stop-loss orders. These are instructions set with your broker to sell an asset when it reaches a certain price. It's a way to cap your potential losses on a particular investment. Lastly, we have the exit strategy. This is about having a clear plan on when to sell your stocks. It could be based on a certain profit goal, a change in market conditions, or a shift in the company's fundamentals. To sum it up, risk management in stock market investing is about diversification, position sizing, stop-loss orders, and having a clear exit strategy. It's about being prepared for the worst while hoping for the best. It's about making calculated decisions, not just taking wild guesses. Remember, the key to successful investing is effective risk management. It's not just about picking the right stocks, but also about managing potential downfalls. After all, in the world of investing, it's not just about the returns, but also about preserving what you already have. Ready to start your journey? You'll need a demot account. A demot account, short for dematerialized account, is akin to a digital wallet for your shares. When you buy a share of a company, it's stored in your demot account. No more paper certificates, Everything is streamlined and held electronically. Now you might be wondering, why do I need a demot account? Well, in today's digital age, a demot account is your gateway to the stock market. It's how you hold the shares you buy and sell. It's essential for trading and investing in the stock market. Think of it as a bank account, but instead of cash, it holds shares, bonds, mutual funds, and other market securities. Just as you can deposit and withdraw money from your bank account, you can buy and sell securities through your demot account. So how do you open a demot account? It's pretty straightforward. You can open a demot account through various platforms, including banks, brokerage firms, and online trading platforms. The process generally involves providing some personal information, including your social security number or equivalent, proof of address, and proof of identity. Upon completion of the documentation, your account will be activated, and voila, you're ready to dive into the world of investing. However, remember that different platforms may have varying charges, including account opening fees, annual maintenance charges, and transaction fees. So make sure to do your homework and choose the platform that best suits your needs and budget. Now, armed with your demot account, you can start buying and selling shares. But remember, the stock market is not a get-rich-quick scheme. It requires patience, discipline, and a well-thought-out strategy. Investing is a journey, not a destination. It's a process of learning, growing, and adapting. So take your time, start small, learn the ropes, and gradually build your portfolio. With a demot account, you're ready to enter the world of investing. So buckle up, because it's going to be an exciting ride. So, are you ready to conquer the stock market? We've journeyed together through the fascinating world of stocks, learning the essentials that make up this dynamic marketplace. We started by understanding the stock market as a hub where company shares change hands, turning ordinary individuals into shareholders and part owners of corporations. We shed light on initial public offerings, or IPOs, the exciting events where companies decide to share their growth journey with the public, offering shares in return for funds. This process allows you, as an investor, to buy these shares and stake a claim in the company's future. We've also explored the different types of investors who operate in this market. From retail investors like ourselves investing for personal growth, to the vast institutional investors such as banks and mutual funds, each player contributes to the market's vibrancy. Then we delved into the concept of market capitalization, a measure of a company's worth in the stock market, calculated by multiplying the number of shares by the share price. This figure gives investors a sense of the company's size and value. We also discussed the rewards and risks of investing in stocks. While stocks can offer growth opportunities as companies succeed, it's important to remember the potential for losses if the market takes a downturn. We differentiated between investing and trading. Investing focuses on long-term growth and wealth building, while trading seeks to profit from short-term price fluctuations. Both have their place in a balanced financial strategy. We emphasize the importance of risk management. Remember, never invest more than you can afford to lose. Diversify to spread your risks, and always have a clear strategy in place. And finally, we touched on the practicalities of starting your journey with a demot account, your gateway to buying and selling shares electronically on stock exchanges. The stock market can indeed be a platform for growth and wealth creation. But remember, it requires knowledge, patience, and a disciplined approach. Always do your homework, seek advice from trusted sources, and invest wisely. Thank you for watching, and best of luck on your journey to financial success in the stock market.